The Australian dollar has tumbled and the local market hit after the US lost its AAA credit rating. Joining us live now, Chief Market Strategist at InvestSmart, Evan Lucas. Just explain this for us. What's the significance of it? The last one was about 10 years ago, wasn't it, Evan, this credit rating pullback?
Yeah, it was. Look, Fitch coming out yesterday sort of caught a lot of people off guard, downgrading the US from their AAA credit rating to A++. Now, why that matters is that obviously it's around the credit quality, but also around the rate that US government numbers get. Their justification's interesting because it's a little bit late, if you want to sort of put it another way to you, Pete. It's down to the fact that they've now had several very much brinkmanship in the capital around getting the debt ceiling lifted. It's also around issues of the Trump administration lag over, and the fact that at the moment they believe that there is just no fiscal consolidation or any form of fiscal responsibility being taken by both sides of Parliament over there in the US, and all of that has led them to downgrade it by a notch. Now, it caught, as I said, the market off guard. Where it comes to the Aussie dollar is that it therefore sort of spreads. It therefore asks the question, if Fitch can look at the US like this, you've got to be looking at all the other G10. And what we mean by G10, that's the big currency players in the world, and that includes the Australian dollar. What it looks for us and whether or not we could also go through a similar situation as well.
Right, okay. So would the RBA then have to step in here locally?
So the interesting thing about that question and where the RBA comes into on that point, at the moment, we now know from, and at least this is our view as well, that the likelihood of a rate rise from the RBA is now pretty low. In fact, we believe they're done. They're finished, and that's where it is. Why the Aussie dollar comes into it is that the other central banks around the world are still possibly going to do it. Fitch is also now added another layer. If the Aussie was to continue to keep falling, it has fallen now almost 2.5 cents since Tuesday. So it was up at the top end of 67 cents. It's now at 65 and the bottom end of that handle and still falling. It means that we start what we call importing inflation. Obviously, overseas products appear more expensive because we've got to spend more money to get them in for the same amount because that dollar is depreciating. That brings the RBA question into the focus. Do they therefore have to step in and stabilise it? And the way they stabilise that, unfortunately, would be rate rises. So that's the only unknown thing, is that the inflation pickup could happen because the Aussie dollar falls too far and inflation picks up off the back of it.
So if there's no more rate rises, what would have to happen for there to be a rate cut? Because I guess that's also a question people are wondering now.
So for a rate cut to be there, inflation would have to be back into the target band, 2 to 3%.
So
but
years away.
Also has, well, no, not necessarily. So this is the thing. That point is interesting. If you actually annualize the inflation data for the first 6 months of this calendar year-on-year inflation is about 2.5%. So it's not that far away, in terms of where it sits. The catch with it is that it would have to be inside the band and falling faster than expected. So it would mean that it would be, let's say it could be 2.7%, but it was falling at a rate of about 0.8 per month. That would be a trigger. That could show that that's happening. But again, it's more likely to talk about rate cuts. We can talk about that in April, May next year. That's probably the earliest you could be suggesting it. There's a lot of water under the bridge that has to happen before that goes. Okay. I think we keep using peak. It's not a peak. It's a table. We're going to have to walk across the tabletop now.